Hey guys, Dave Keller here with Market Misbehavior. 2024 so far has started with a bit of a whimper, which is a very striking contrast to the very strong growth-dominated bull phase that we experienced out of the October low and through much of the fourth quarter, really through the end of last year. Now we're starting to see the S&P 500 roll over a little bit. What's interesting is, from a seasonal perspective, if you look at an election year, this is actually quite common. Today we're going to talk about the seasonal trends and why Q1 could be a little more painful than you expect. So as the S&P 500 has pulled back a little bit after retesting that 4,800 level, we're left to think, is this the beginning of something a little more significant to the downside? What sort of corrective move might we be experiencing in the first quarter? To be honest with you, if you were studying seasonality, if you've looked at seasonal tendencies, particularly in an election year like 2024, you'll know that weakness in the first quarter is actually quite common. There's often a major market low sort of in the March timeframe, very similar to what we saw in 2023. And it usually sets up things up for a nice rally into the second, into the third quarter before another low in October, but we'll get to that later. When we think about weakness in Q1, we're going to look at the seasonal tendencies and how the numbers have actually stacked up. We'll look at a breadth indicator called the McClellan oscillator, just triggering a sell signal this week, the first trading week in January. And I'll show you one chart I'll be watching to sort of differentiate between a brief pullback and something a little more dark and sinister. Before we get to the charts, here's one more thing to tell you about. The new year is a really good time to focus on routines. What do you do every day, every week, every month to improve your situational awareness as an investor, to identify potential opportunities and also manage risk? Seeking Alpha provides a quantitative model, they call their quant rating, and I think it's really well done. A lot of the institutional investors that I've worked with always had an alpha model, which is basically a quantitative model. It's a way of looking at the statistical measures that define healthy companies, strong companies, companies most likely to outperform going forward. Then you take all of those factors, you combine them into a model, and then you regularly run it to find companies demonstrating those same characteristics. By scanning for stocks showing strength using the quant model on Seeking Alpha, I think you have a good opportunity to identify potential opportunities that could help your portfolio going forward. If you go to marketmisbehavior.com/Seeking Alpha, you can get a great deal on their premium membership, which gives you access to their quantitative model, also all of their scanning tools, and also a lot of premium commentary as well. So go to marketmisbehavior.com/Seeking Alpha. Start off the new year with a gift to yourself, the gift of better market awareness and a better sense of the opportunities of leading companies. And now let's get back to the charts. So here we're looking at the S&P 500. Of course, if you've been following the markets, you know this drawdown that we've just started to experience really from the last week in December right into the new year here. And the first couple trading days of January so far have been a little more risk-off than we were comfortable with in November and December. What's interesting is if you look at the chart of the S&P 500, there's some really clear levels not too far below where we're at right now in early January. 4,600 is this green shaded area. That was the peak from July of last year and was a key breakout level, I think, in the beginning of December when we finally broke above 4,600. I think there was a key vote of confidence in this bullish rally off of the October low. Now that we're pulling back a little bit, oftentimes the resistance that we experienced previously can often serve as support going forward. So that's one level I would look at. Below that is, you can see the gap that we have here in November, right? Sort of 44.20 to 25 to 44.50. The S&P 500, the QQQ, they all have that gap right around that same level. That's when the October CPI number came out in mid-November. I think as long as we remain above that sort of level on a pullback, overall the longer-term structure is still pretty good. But what gives with this sell-off at the beginning of the year? Here we're looking at a seasonal chart. This is on StockCharts. You can actually look at up to 20 years of data, and you can look at seasonal trends. So if you're not familiar with this visual, I'm looking at the SPY, so the S&P 500 ETF, and I'm basically looking at the 12 calendar months. The histogram tells you the percent of time that this month actually finishes stronger than it started. So 40 means 40% of the time January was a positive month. The number at the bottom of the histogram, each bar, tells you the average return. So out of the number of observations I've highlighted, which I'll mention in a minute, the average return in January is negative 0.9%. Now, if you look, I brought in 20 years of data, that is, but I'm only highlighting the election years. So 2024, of course, is an election year. A lot of expectations about what that might mean. The two candidates, the leading candidates, and what that race, how all that will shape political or policy going forward. But if you look back to 2020, 2016, 2012, 2008, and 2004, we can now look at the seasonal tendencies just in an election year. Look at Q1, January, February, and March. All three of those have an average negative return. Only 2 out of the 5 years that I've highlighted have those months been positive. So most of the time, more often than not, January, February, March are actually down months for the S&P 500 only in an election year. Now, if you bring in a broader period, and if you just look at the last 20 years, you'll find January is actually one of the weaker months. And a lot of times there's sort of a reset to the markets in January. Particularly the last couple of years, we've had a weaker January than you might have expected. But just in election years, 2 things to mention. Number one, maybe 3 things. Number one, you tend to have a weak first quarter. Number 2, you tend to have strength into the summer. And note how August has been up 100% of the time in an election year with an average return of 2.3%. That makes it one of the top performing months of the year. You'll also notice this thing right here. Last year in 2023, we had a major low in October. That's actually quite common when you look at the 12-month calendar, and it is especially common during election years. If you look back at these last 5 election years, the average return in October is negative 4.3%, and only one of the last 5 election years has October been a positive month. So we have some expectations, if you use the seasonal tendencies, of strength through the summer, of weakness in October, and most likely a rally to complete the fourth quarter, similar to what we saw in last year. But note the exaggerated weakness that we tend to see in the first quarter. All 3 of the months in Q1, January, February, March, tend to be down months, and they tend to be down more often than not. Now, how can we actually chart this deterioration, this potential deterioration in the first quarter? 2 charts that I'll show you. Number 1, the McClellan oscillator. The McClellan oscillator is a breadth indicator derived from advanced decline data. And I have the McClellan oscillator charted in the top half of this chart, is looking back at the last 12 months. And they have the S&P 500 in the bottom just as a reference point. Now, I've color-coded this chart. In green means the McClellan oscillator is above 0. In red means the McClellan oscillator is below 0. You can probably guess from the colors I've chosen. And if you look at the performance of the S&P, you see it plays out pretty well. When the McClellan oscillator is above 0, that means the breadth data is improving and the conditions are strong. As a result, the S&P 500 is most likely going higher. We've recently been in a period from late October to now early January where the McClellan oscillator had pushed above 0 and remained up there for a very long period of time, almost 2 straight months. And of course, that was a very strong period for stocks coming out of that October low. You'll notice previous times when the McClellan oscillator has tended to be above 0, the market has tended to be in a bullish phase. Look at the red shaded areas though, because we just broke below 0 this week. And to start the year, the breadth data is turning, and in terms of this particular indicator, from strength to weakness. When it's below 0, that tells you the breadth data is weakening, meaning the advanced decline data is starting to roll over. And as a result, the red shaded areas tend to coincide with corrective periods. Now, not big, major, year-long corrections, more shorter term sort of tactical corrections, but you'll notice a lot of the times the price is down on an absolute basis. Maybe an exception would be mid-April to early June of 2023, when the market wasn't really in a price correction, but more in a time correction. You have to remember that markets can correct in 2 different ways. In price, meaning the price actually comes down, we have a drawdown, or time, meaning the uptrend is paused as the market sort of reaches an equilibrium and before you reset for the next move higher. So the fact that the McClellan oscillator has turned below 0, I would say confirms the normal seasonal tendencies of expected weakness in the first quarter. And I think as long as that oscillator remains below 0, it tells you risk off is probably a better approach to these markets than risk on. Now, what could validate further weakness and tell you that things are really starting to get squirrely, as it were? I would look at the VIX, right? The chart of the VIX really speaks to the volatility of the market. Now, this isn't looking at the S&P itself. It's actually looking at the options market, index options for the S&P 500, and basically looking at the volatility of those options as a way to infer or imply the volatility of the S&P 500 itself. The VIX has been remarkably low, really, for the last 6 to 8 months. We got back in June of last year down below 15, settled down to around 12 to 14. That's that green shaded area, and you can see that it's sort of the lower end of the range. In mid-December, we actually got down to 12, which is one of the lowest readings we've had in years. the VIX is just starting to pop higher. You can see it's testing the 50-day moving average in blue. And I would say a pullback in stocks most likely and most often coincides with a pop in volatility. Now, why does that happen? Well, I'll tell you what, it just tends to it tends to be related to how investors tend to buy and sell stocks. When we are optimistic and we buy, it's not a panic buying, it's not a stressful situation. You kind of feel optimistic, you feel constructive, and so you're willing to accumulate shares over time. But when things really get negative, we don't tend to calmly and rationally hit the sell button. We tend to freak out and dump everything and just get out of the way. That excessive trading, that panic selling is what causes the volatility to go up. And that's why volatility tends to move inversely to the S&P 500. When volatility is low and then starts to pop higher, that usually coincides with market pullbacks. So if the VIX continues to push higher as the McClellan oscillator remains below zero, that could confirm more of a bearish phase that, again, is very normal based on the seasonal tendencies of Q1 in an election year. What do you think about that seasonal tendency, weakness in January, February, March? Do you think early 2024 is going to follow those normal seasonal patterns? Make sure to drop a comment below and let me know. Don't forget, by the way, to like this video if you could and subscribe to my channel. I'm right at 10,000 subscribers, which is such an awesome milestone. I never imagined we would reach, and I would love if you would help me get to that next 10,000, get to 20K plus. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, and we'll talk to you again soon.